I usually don't feel jealous about people, but there's one thing that I feel jealous about, and I'm going to tell it to you. You are one of the few people in India who got to interview Bono and The Edge when they were in India. So I'm a big fan of you two. So tell us, how is Bono like in person? How is it like?
He is amazing.
I have a short intro for you, Mangalam. You want me to go?
For it. Yeah.
All right, here we go. In this episode, we have the wonderful research analyst and assistant editor of CNBC TV 18, Mangalam Maloo, an analyst who lives and breathes FMCG because hashtag FMCG is life. I'm going to pick his brains, try and understand his perspective on the market, how to make money, essentially to bring value to every member involved in the finance community of India. Mangalam Maloo, thanks for coming on. I've been trying to get you on since a few months, and finally we have you here. Thank you for joining. How are you doing today?
I'm doing well. First up, Akash, thank you so much for that really sweet introduction. But more importantly, a big apologies as well. Like you said, we've been trying to make this happen. Just there was a lot of travel involved and all of that. So unfortunately, the stars couldn't align, as Seema Taparia would say. And now that they have, I hope that works.
Yep. I mean, it's been a busy market day, right? Like the last quarter has been tremendously taxing for everyone involved in the media houses, every investor, trader. I mean, we've seen lots of ups and downs. So it's understandable. And then there was the season.
Last couple of quarters, actually, to be very honest, Akash, because usually what happens is that Q4, the time for companies to report their results, the window is extended because it's the annual results for a lot of companies as well. Most companies actually in India currently report on an FY basis, which the year ends in March. So for them, the result season is extended all the way up to May 31st. And then you have, within a few days starting, you have Q1 results as well. So that entire 4-month block is usually quite, taxing. So anytime that you get, you just want to stay away from all things market.
Yeah. So it's going to be a very interesting podcast. I have informative questions that even you'd be quite engaged. And first let's get...
I hope I'll be able to answer them.
Yeah, sure. I won't take too much of your time. Let's just let's just get to the basics. Like, how did you start in the markets? What's your story been like so far?
A couple of things, Akash. First up, so I was simultaneously both a media person as well as a finance person. So my education was first in mass media. I graduated in mass media. And while I was doing that, I was always a big fan of the way numbers would work, the way accounts was there, etc. In 11th, 12th, I had taken up commerce, etc. So towards the third semester, or rather towards the third year of the sixth semester, we did have a course on financial accounting, which I did extremely well on. And as a result, I thought there is a fair amount of interest that I have both as well in creative as well as the financial end of things. So might as well for my postgrad, let's look at an MBA in finance. And while doing that, you know how the CAT system, etc. is. You have a few months on your hands. So that is when I started reading the CFA books too. And by the end of it all, I had both a CFA degree as well as an MBA degree, so to say, along with something in graduation. Graduation was in media. So by the end of, structural academics, I had both specializations in media as well as finance. And you club both of them. Where do you go? You go to CNBC TV 18, and that's exactly what I did.
The best part.
Yeah.
All right. Before I ask you any market-related questions, I'm going to make a disclosure. This podcast is for educational purposes. None of it should be considered as an advice. I'm speaking to someone that you would be listening to every day. And this is just for education purpose. He's not coming on from CNBC. He's an individual right now.
Yeah, and also, I mean, whatever disclosures you need to be making, I mean, it should be taken on board that it's not any stock recommendation or any sort of comment that I make on a company would be purely for example purposes, not only education purposes.
Awesome. Great. All right. So I've divided this podcast in kind of simple two segments. First is like you need to have the right mindset to make money in the market, obviously. and then the strategies, everything. So I'm going to ask you one by one. Let's start right off the bat. What do you think? What's the current state of the market, macro view? Where do you think it's heading? Any interesting data points that you're tracking?
A couple of interesting data points that I'm tracking. For starters, there's the longest streak of FII buying that we're seeing all the way since Jan 2021. So it's been almost 18 months since the FIs have, eluded us, and now that they're back, that is one end of the things that is supporting the market. And that having supported the market, meant that there was a big rally that we saw all the way from 15,400 to about closer to 18,000, notwithstanding the decline that we saw on Friday, which again was par for course, primarily because of the way in which we had run up. A few macro factors that really stand out. The first one, of course, is that, while there are worries about global tightening with regards to liquidity, etc., and the global fight against inflation, some of the data points are indicating that maybe the worst of inflation is behind us, be it in India or be it in the US as well. So the inflation which was first imported has now, we're seeing it moderate from the highs that we've seen, though it's nowhere near the comfort zone of a lot of the central banks, etc. We may see some tightening, but stock market's forward-looking animal. Every time it sees that, maybe this time around inflation is moderating and the path that the central bankers have stuck to may see it moderate to a more comfortable level by, say, the end of this year. So might as well try and price that in as well. So that's exactly what explains the rally that has taken place so far. But now that the rally is taken place, the important question is how much of it is in the price and how much is still left. To that, there are two things. One, to believe that margins for companies have bottomed out would be right in a way that, there's no further stress that is available right now or visible right now, but the margins are going to meander around current levels only, not improve by a wide much, is what my belief is. Why is that? One, because of the second quarter, a lot of the companies are stuck with some high cost inventory. So they will have to obviously, liquidate that. So that would impact their margins. And we've heard that from a lot of the companies that have reported their numbers. And the second part is that inflation is pinching people's pockets. So it is not that the price hikes that have been taken will not have to be passed on as soon as input prices moderate. So while companies may not explicitly announce price cuts, what they will do is they will announce volume increases, promotion offers, etc., all of that to spur demand. The third part is that over the last few years, ever since the pandemic has started, one big area of spending for companies has been advertising, which was reduced on by a severe margin. And as a result of which, the kind of share of voice or share of air that a lot of the second or third level players would have had has gone away as well. The larger players have maintained their share of voice, they've maintained their share of ad space, they've maintained their share of airs, etc. So whatever savings that companies do in gross margins, they will go ahead and also, increase their ad spends. So whatever we see with regards to in gross margins may not come back to your EBITDA or net profit immediately. Mm-hmm. So the thesis that margins are going to surge in the second half, they will improve, but it will be a gradual improvement as against them surging.
Makes sense. And when we're talking, the markets have rallied despite all the negative information that we have had, inflation, we're just factoring in that all of it has been priced in. Let's talk about somebody who has just entered the markets in this bull rally, let's say starting from 2022. Despite everything like Ukraine crisis, knowing that the Fed is going to tighten its monetary policy, everything, it has continued to rise in 2-3 months. It has factored in every negative information. Now, I was just looking at the last 6 months news, just seeing if there is anything that has been ignored. I kind of think that in the Indian market, there's not a lot talk about China's real estate prices. Yeah. Do you think that is going to be a big pain behind us, or is it behind us, or do you think it's coming ahead? Because it kind of directly affects us, because China real estate, then invest Chinese real estate markets, they're going to need some sort of funding. The government has announced bailout plans to help retailers, but then there has to be some sort of revenue for them. Biggest is they have invested in US tech companies, so they might cash out from there. US, you understand how it happens, like mother market crashes and then the tail effects reach to India. Do you think that is still left for us?
I don't think it will go to the extent that, it'll be a full-blown crisis where they will have to liquidate the investments that they have overseas, etc. The bigger worry is that we don't know the size of this problem. That is a bigger worry. And, data coming in from China, you and I know, is indicative at best. It's not accurate always. There is a bit of a problem there, yes. And at the same time, what counterbalances that is that the fact that there is a bit of a problem there would mean that a lot of the emerging market investors, a lot of the flows would choose India over China. So that would be a counterbalancing that would be a counterbalancing factor. The second thing is that with a bit of a crisis out there, etc., or China not being, it is still by a far mile a big manufacturing hub for the world. Everyone's looking at a China plus one strategy. We do read a lot of experts saying that India would be a big beneficiary of that if it's China plus one. But my sense is that even if it's China plus 0.5 or it's China plus 0.75 and not necessarily China plus one, and even if part of that does come to India, we would stand to benefit in the manufacturing end of the GDP. And that would aid a lot of companies, etc. So that shouldn't be as big a problem. But again, like you said, if there is something which is extremely unpredictable that takes place, it'll of course be difficult to time that, difficult to trade that, and difficult to anticipate that. Because in the markets, usually what happens is that when you and I, put our collective minds, think of the big macro factors that might play out, etc., you and I might get the macros right. But at times, just getting the macros right does not mean that you will end up making money. When COVID was at its peak and Fed and all the central banks across the world had started pumping in liquidity, the macro call that everyone would have made at that point is that inflation is going to be extremely nasty. There will be a big surge in inflation, and there will be a big global economic crisis as well. Well, macro-wise, they would have gotten it right on inflation. But the inflation impact started coming to the markets as well as everyone's portfolio much later. In the interim, there was a rally, a massive rally that was led by that liquidity. So if you would have gotten your macro call right, you wouldn't have made a lot of money without looking at the micros and the prices. So I understand that, there are a lot of factors which are playing out, etc. When they play out, how they play out, the prices will tell you. And everyone will get enough time to either get out or probably get in.
Yeah. All right. So that was very interesting. We're talking everything about global macro factors and everything. Let's think of it from a retail investor's angle. They do not understand all these jargons that we're talking about. And there's a general notion on the trading floor and everything that you guys have special access at media houses about investing, about management. And I was talking to one of my colleagues who works in one of the brokers. I've told him, like, this is not true. They look at the same data that we look at, the exchanges and everything. They're just smarter than us. Let's say that. So let's clear that air for now. Do you have anything to add to that?
I don't think I don't have to add anything from that. In fact, I'll just subtract from what you said. I don't think I'm smarter than anyone else. It's just that we're a lot more consistent and we have a lot more processes in place, in the sense that we're constantly tuned on a daily basis to what every company is putting out on the exchanges. We have all our research database streamlined in a way that we have all the quarterly numbers, all the annual numbers, etc., punched in manually by all of us in our databases. And we have a lot of our notes that we make on a regular basis, because breaking news is I say often that it's like standing on the slips. You just have to be ready. Chances are that the entire day the ball never comes to you, but the one time the ball comes, you can't drop it. So I would allude our coverage or understanding of things mostly to our readiness, and not at all to any sort of special access or any non-public information. Because I mean, non-public information is not our currency.
Exactly.
Because if we have information and we're sitting on it and not making it public, then it does not help us.
That's true. All right. So we were talking about interest rate because that is one of the major factors affecting us. I kind of believe that in any kind of market scenario, whether good or bad, some sectors are gaining out of some situation or some market behavior. Looking at current dynamics, we're not going to talk about stocks specific. Let's talk about sectors. What do you think? Which sectors are going to gain out of, let's say, maybe if not 50 basis points rate hike in the coming September meeting, because that's been anticipated. If it's higher than that, 75 basis points, just like last time. What do you think? Which sectors would benefit out of it?
So this is how you look at it, right? I mean, the obvious beneficiaries of a higher interest rate perhaps would be people who earn in the interest rate. That would be banks. That is obvious. But does that always happen? Perhaps not, because banks have to increase the interest rates. That would mean that a lot of companies would reduce their credit offtake, etc. And I wouldn't believe that interest rates solely would determine what sectors benefit, primarily because, I mean, that's just one cog in the massive wheel. For banks, you would have their cost of funds increasing as well. So that would be an offsetting effect. Those are a couple of factors, the obvious things. But my sense is that with where we are right now, and not looking at purely the interest rates, what we have to look at is if the interest rate goes higher, does that have a concomitant impact on inflation? If inflation comes down further from what it is right now, then obviously you have the commodity users who will benefit. The biggest of them would include, the auto pack, because you will have the prices of metal coming down, you will have the prices of fuel coming down, you will have the prices of all the other input costs coming down. And we've seen that in the kind of rally that we've seen across the auto space this year. The second big beneficiaries, of course, would be the consumer space, both discretionary as well as staples and durables. Because again, the cost of commodities that are there or the cost of their inputs would start coming down. On the other side, the ones which produce those commodities or, gain from these commodities being higher, be it the likes of metals, etc., may see a bit of a decline. But in metals in particular, the impact is a lot more global than local factors. What the Indian Reserve Bank does is not as important in the scheme of overall market situation as the US Fed doing that, because the US Fed also determines the kind of flows that come into India. And that is a big factor in the direction, at least in the near-term direction of the market.
That is true. I mean, I was just going to bring up consumer product companies. I was kind of thinking from an oblique angle the other day, not the other day, but let's say 2 quarters ago. If I were dumb, I had no knowledge of the markets. I've seen the rally after post-COVID. There's been a lot of liquidity, but for somebody who doesn't know markets, you can kind of understand that kabhi na kabhi to market girega, right? So the theme that I thought from that angle is, what would people do when they make bad financial decisions in the market? They're stressed, right? So they smoke cigarettes, drink alcohol. So I kind of put my money in ITC. It was hovering around 200 at that time, and it has been working just fine right now. So small cases did great on this front. They started theme investing. Maybe I should launch a stress small case theme.
Well, that's interesting because had someone bought ITC at 200, say, a couple of years ago, the stress was a lot more during the COVID levels, but no one smoked a lot more during COVID, right? Because things were shut, etc. as well. So there are a lot of factors that played out. Of course, that definitely not only stress and people wanting to drink more out of stress or smoke more out of stress, but you got your timing right on ITC, and
Yeah.
I congratulate you for that.
I thought, what's the worst case scenario? I'm going to get 6% dividend yield. Out of best case scenario, I'll have an interesting story to tell, and now I have it.
Exactly, that's you have the interesting story to tell, and you still are getting the dividend yield at the price that you invested in the company, that will be around 6% as well. So how do I don't know. Your question was about what?
My question was the same kind of question that if there were maybe people who do not understand markets, how would they be playing out such things? The right balance. The next question was, how do you understand in such situation? Do you have to be extremely smart to make money? Do you need a degree? Do you need some sort of practical experience, or you need to enroll in coaching or something? Do you have any takes on that?
So a couple of things. The first thing that if you have absolutely no idea of where to invest, what to do, etc., and it's left best to two things. One, it is prudent to perhaps give it to a fund manager who does that for a living, and you will give them a little bit of a fees, but at the end of the day, you'll be sure that they are going to do a better job than what I would do, because I don't know much. It's like going to a doctor if you're not feeling well. You don't self-medicate too much, because self-medication would work so long as it is close-in, etc., but it won't beyond a certain time. The second part is that if you really do not understand anything about finances and do want to make some money in the stock markets, index investing is extremely prudent to do, because the NSE or the BSE, they're making these indices for people based on certain parameters. And if you notice, irrespective of the constituents of the indices that have changed over the last 50 years, the index still has compounded in double digits. So you are assured of a double-digit return. The third most important thing is that you do not have to compare your returns with anyone else's. There's not a game where everyone says that, oh, I made 10x of my money, you made only 3x, so that means you are smarter, you are dumber, and I'm smarter, and all of that and stuff. The idea is to compound your wealth and not lose your money. Warren Buffett, classic Warren Buffett story. Rule number one, never lose money. Rule number two, never forget rule number one. Yeah. So to that extent, generating alpha, I think alpha is extremely overrated. There are two kinds of return in the market. There is alpha and beta. Beta is what the market returns itself. Alpha is what you try and generate over and above what the market has returned. So I think alpha is highly overrated to the extent that, if you generate beta enough for the long term, you are going to be in a reasonably much better place than anyone else, as against generating alpha for the short term. So the idea is to, be extremely calm, very composed, prudent, and be sure of the return that you can expect along with the risk that there can be. And stay around for the longest time. This is not a 100-meter dash. Everyone says it's a marathon. So play it like a marathon. And you don't need to be extremely smart. The problem is that extremely high intellect in the stock market can actually prove counterproductive as well, because then you will start thinking of situations based on your IQ that may not have played out yet, or that you may start overreacting to smaller situations, because you would just think that, okay, a small thing has happened. It can compound to this. And you're playing out the story in your mind without the story actually having happened. So you act on that, and then you'll miss out on the biggest gains just because that story either did not happen or happened much later, or happened at a time until when the stock had rallied enough. So I would say discipline, contentment, and a process is more important than being extremely smart. You just got to be slightly above average in terms of understanding things for a long term, and just generate beta without losing any money. You'll be in a much, much, much better place than you can ever imagine at the start.
That's amazing. Discipline, contentment. What was the third one? You need to highlight
What
that.
is the third one?
First one was
What is the third
discipline, contentment, and the third one was
Keeping your composure.
exactly. Yep. I'm going to highlight that. The last question in this segment, I wanted to ask about: do you suggest reading books to understand the market behavior, mindset, everything, or would you suggest to get practical experience? If so, is there any platform to understand market psychology or any books that you would recommend? Investing strategies, all the factual data, what ratios, balance sheet, everything about financial jargons. I'm talking about market behavior understanding. Do you have any advice for them?
There are a lot of behavioral finance books out there in the market, so you can probably read some of them, and that would help you. I think the one book that really changed my life when it came to understanding stocks, etc., was Fooled by Randomness by Nassim Nicholas Taleb. And the other one, of course, was his previous book, which was The Black Swan. But Fooled by Randomness was one of the most amazing reads that I had. The other one was Neil Ferguson's Ascent of Money, that told you the history of money and how things happen. You want to watch a documentary on that. I think there was a BBC documentary on the ascent of money too.
Okay.
I'm not too sure whether it was BBC or some other production company or etc. But you will get access to that online. The other things that you need to know before embarking on your investing journey, or before you start reading, etc. There is no one particular book that will make you smarter, but books in general will make you smarter. So you don't need to look for books as the immediate solution. Again, you keep reading, and you won't realize after, say, your first 20, 30, 40, 50 books, you will start liking to read itself. And once you're done with 5 years or 6 years of reading, you will suddenly realize that, okay, you know much more than the average Joe. And that will help you understand yourself better. And once you understand yourself better, you can understand everything else better.
Awesome. Now I'll ask you questions on strategies. We have gotten so far about the mindset and everything for the markets, market behavior. Let's talk about strategies. I mean, since you're a CFA, you have a good amount of knowledge to develop strategies. I mean, you've worked in trading department as well, and I'll get to that in a moment. But let's first get this question that has been long debated: value investing or momentum investing?
It depends on what your duration is.
Right.
If in momentum investing, it's never momentum investing. It's usually momentum trading.
Yep.
Can you hear me?
Yeah, I can hear you.
It's clear?
Yep.
Okay, I'll go for that answer once again. So it's a couple of things. You can't call it momentum investing because it's usually momentum trading. Value investing basically usually a corollary of growth investing versus value investing. Growth investing is where you're looking at companies which offer growth as against which is at a slightly elevated valuation. Value investing is things which do have deep value, etc. in it. Whereas trading is completely different, where you're looking at just the price and nothing else. So the bigger distinction that needs to be made is whether it is a trade or an investment. If it is an investment, before you get into that investment, you have to have a thesis that, okay, this is the reason why I'm investing in this company. These are a handful of thoughts that I have. And if these are my thoughts which don't align with the markets and, eventually I'm negated, then I'm okay losing out on the money that I've made in the investment or losing out on the money that I've invested, because everyone has the right to be wrong. Whereas when you are looking at a trade, you are looking at nothing else but you are looking at the price, right? You are looking at the price of a certain thing, thinking that, okay, at this price, these are important levels which the stock is looking to reach, or the stock is looking at a support, XYZ, whatever your thesis of that trade is. It could be any stock, to be very honest. Or if it's a trade based on an underlying macro that you are looking at, say suddenly rubber prices have come down, so you expect maybe some tire companies to do well, etc. Then you have to look at how the prices have behaved already, how much of that is in the price. You're going in for a trade with a certain stop loss. So the point is that whether you are investing or trading, you need to be one clear as to is it an investment or a trade. After that, only you commit your money to that investment or trade. Don't buy first and think whether it was an investment or a trade later. When you are investing, you are not looking at just a particular price target or a return. You are looking at your thesis. So if your thesis is wrong, you exit. If your thesis is correct, you stay on till your thesis is correct, because that is when the benefits of compounding come by. But when you are looking at a trade, you are not looking at thesis, you're not looking at fundamentals, you're looking at the underlying macros, the reasons for which you entered your trade, for which you have a stop loss and you have a target. Once your target is achieved, it's best to sit on the money and regret not staying on for longer than not sit on the money and regret losing the money or sitting on a drawdown. If you have a stop loss, you respect that stop loss, get out of it, and there is no ego hurt in this. Never do ego investing that, okay, I am XYZ, this is why I think this is going to be great. I go ahead and make that investment. If the stock falls down, you don't think you are negated, etc. Just respect the market and get out. It's pretty simple, because the idea is to keep your victories much bigger and keep your losses much smaller. And over a period of time, that is going to benefit you.
Very rightly pointed out, Mangalam. Ego investing. I've been guilty of it too. I'm going to say it up front. Your short-term investing that you had taken a trade for, let's say, a month or even a few days becomes your long-term holding for 3 to 4 years. So that I have been guilty of it too.
Everyone at some point has been guilty of ego something. It could be ego investing. It could be, if you're a fitness person, you go to the gym, you see someone else doing much higher weights than you. You try that, you can't lift it. You're like, oh, let me just go ahead and do that because I'm a smarter person. How are these weights going to hurt me? Well, you never do ego lifting as well. Never do ego investing. Never do ego batting as well in cricket. If someone's sledging at you, or you don't like the bowler, or you don't like the person who's bowling at you, or the opposite team, etc. You just want to smack them out of the park. Never do that. Just play the ball on their merit, play the weight on your body's merit, and play the stock, the investment, or the trade on its own merit.
Pinch the right now, Mangalam. I've been guilty of that as well. I've injured my shoulder because I lifted more weights than I could. My body could afford that time.
So, which is why I said, right, that you don't need to read a big fat psychology book or read a big fat finance book to be able to learn something. I mean, the reason why self-help books do extremely well in our country is because people love reading it. No one likes implementing it. And when you read it, you're like, oh, ye to mujhe aata hai. I know this. I mean, you have to be disciplined. How many of them would have read Atomic Habits? So many, going by the sales numbers of that book, but how many of them have actually implemented that? The idea is not knowing something. The idea is practicing that. The idea is actually applying that on a daily basis. You do, I know X things about fitness, but I don't give that 10 minutes, 15 minutes, 20 minutes, or maybe 40 minutes on a daily basis to my body. All that knowledge goes to waste. So you have to apply in any form of, any vocation, be it work, life, or anything. Consistency is more important over the long period than near-term flashes. Consistency across anything is so underrated, because over a period of time, you realize the benefits of it only after, say, 5 years, 10 years, 15 years. Whereas in the near term, you see results immediately. But I mean, what are you going to go for? Near-term immediate results, which are not sustainable, or consistent things which are sustainable over the long period?
Yeah, that is awesome advice. Let's back up a little bit on that. I have a follow-up question, because you mentioned stop loss, something that people ignore a lot. That falls under risk management. Do you have any holy grail risk management system on that, like capital-wise? If it's 1 lakh or even 50,000 or 10,000, let's go for as simple as 10,000 rupees. Do you have any risk management style for that?
I don't particularly have any risk management style right now because I haven't actively invested slash traded in the last 7.5 years ever since I joined CNBC TV. Before that, I was managing trading strategies for the prop desk at BNT Securities. So out there, our risk management system was pretty simple. We had our trading strategies made based the prices. We had made our systems, which was practically one step short of algorithmic trading. So based on the price targets that we had on that algorithm, we would either get stopped out or we would cut our losses, the trading stop losses, etc. But I mean, whatever little I understand so far, what I can tell you is that the best risk management strategy is to have an absolute loss limit that you cannot go beyond in a particular stock. So for instance, if you gave me an idea of the 10,000 rupee investments that I have, and I have decided that of 10,000 rupees, I will allocate, say, 10% to a particular stock that brings you 1,000 rupees. Am I going to, should I lose 5% of that 1,000? Should I lose 10% of that 1,000? Or what is the maximum amount that I can lose on that stock? If the maximum amount that I can lose on that stock is, say, 1,000, then I decide my position size, right? If I want to lose the entire 1,000, I go all in and buy 10% from the capital that I have. Or else, if I have the access to leverage, then I leverage the extent that my stop loss will be placed at, say, 1,000 rupee loss straight. So for instance, if I leveraged it 5 times with 1,000 rupee this thing, I've gotten access to 5,000 rupees worth those shares, then my stop loss automatically comes down to 20%. So as soon as the 5,000 rupee stock falls to 4,000, I have lost 1,000 rupees, I will get stopped out. So basis these factors, you decide how much. Risk management is more about how much you are willing to lose more than anything else. Once you've defined that, you make your strategy around the amount that you're willing to lose, and you get out immediately as soon as that amount is reached. Because what happens otherwise is that the fear of, or the ego investing takes place, and that unfortunately can actually be much more detrimental than anything else.
Yep, that is great. I mean, it's simple. People get confused that they get overwhelmed looking at all the new features that now all the tech, trading portals have. It's more about how much are you willing to lose. There are different jargon, stop loss, and there's trailing stop loss, then different kind of order types. I mean, people get confused with those terminologies. It's just about how much are you willing to risk in a single trade.
Keep it extremely simple. Keep it extremely simple. Investment is more about simplicity. And the only unfortunate part about simplicity is that it's often mistaken with being easy. So simple and easy are two totally different concepts, right? Just because it's simple need not make it easy. And just because it's complex does not make it difficult. It's easy and complex, which are easy and difficult are two other things, and simple and complex are antonyms, not the other way around.
That was one of my reasons I started making content on online platforms. I wanted to make these financial terms simple so that everyone can understand, and they don't go buy some course claimed by an alleged expert analyst that they'd be scammed from. So yeah, that is amazing.
Well, I don't know. I don't know enough about these courses, etc. I am told that there are a lot of them, and a lot of them are scamsters too. But I mean, it's no different from a lot. I'm sure it's no different from being scammed on multiple other levels on a daily basis, right? The idea is to just be alert, and the idea is to tell yourself that a course like this is not going to make you rich or poor. It is what you do after that which will make you rich or poor. And is there a tool that this course will teach me, or is there a tool that I need before I embark on my investment journey? So the idea is more, how do I explain it to you? Let me give you an example. Okay, it's like I have a group of friends and we play cricket on turf every day, right? I go to the sports shop one day to buy the best bat, the best pads, the best cricket kit, and then I go to the turf thinking that I'll be a great batsman. That doesn't happen because one, I don't know how to bat. I haven't practiced batting. Secondly, the turf that I'm playing in does not require the pads, gloves, etc. because we're at the end of the day playing with a tennis ball. So should I invest in all those things? No. I should reflect before going. This is the turf. This is the kind of game we play. This is the kind of skills that I need. Maybe I would need decent turf shoes that will protect me from falling. So I will go invest in them. Maybe I need a slightly lighter bat. Maybe I need a tennis ball, etc. Those are things I will invest in. You need to know the game to be able to invest in the tools of that game and not just go to a sports shop and buy everything that is there on offer just because you think it will make you a good batsman or a good player. So that is the advice that comes for all the other courses, etc. as well. Maybe there are some people who are offering certain courses which would actually be worth investing in for particular people who need that particular tool. So the idea is to know what you want and get what you want as against just going and hoping to find something. It's pretty simple, right? You heard that old saying that if you don't know what you stand for, you're going to fall for anything.
Exactly. Yeah. I'm not saying all courses are bad. There are amazing courses. Elon Market, Stock Edge app. They have so many amazing courses from expert investors, seasoned investors. Like Vivek Bajaj himself is an amazing trader. So he has his own strategies that he has given out all of them for free. I mean, I've taken a few of courses and they are amazing. I'm not saying all of them are bad. People who claim that they have the best advice, they have the best system that will help them make money. I mean, that's a bad marketing strategy according to me.
No, but my sense in that is pretty simple. I mean, if someone is claiming that they will make the best system so that they can help you make the greatest amount of money, then why don't they make the system for themselves and make the money themselves? That's you gotta look through all of that.
It's difficult to understand. Okay, now I'm going to get into the best part of this podcast. This is going to be quite engaging for you as well. I'm going to tell you a few parameters. This is about evaluating companies and understanding financial modeling, everything about that. That's all the numbers are arbitrary, obviously. I mean, it's based on your discretion and people who have different systems. But by and large, people who have some sort of experience in the market have their own perspective of the market. So let's go take an example of any FMCG company or something, consumer products that because retail investors, the simplest access they have is they'll be buying some sort of shampoos or face washes or something. So even those companies have generated gigantic returns. So how do you understand which company or which products that they have companies that should be investing in? And I've kind of made a few data points and I'm going to ask you.
Sure.
How do you identify moat of such companies? Moat is basically for people who don't know, moat is competitive advantage for that particular company compared to other peers. So whether it's product or different aspects.
There are a couple of things that are important in identifying moat, and Porter's 5-factor model has usually been one of my biggest learnings, or one of my biggest tools that I deploy towards finding out whether there is a moat towards that company or not. When you just look at an industry, try and find out where the negotiating power lies, who are the consumers, what is the size of the industry, etc. Is that product a niche product? I will use, again, this is purely for educational purposes. I will use, the example of Fevicol as moat. This is how I identify Fevicol having moat. What is the biggest moat that Fevicol has? A lot of people would say the brand, the positioning, etc. For me, the biggest moat that they have is the Fevicol Champions Club, which they have, which was basically like a Facebook before Facebook for all the furniture makers. They have this huge community of over 5 to 6 lakh furniture makers, carpenters, etc. So while you and I just watch the Fevicol ads and at best buy Fevicol for home consumption, majority of Fevicol is being bought in the country by carpenters and architects, etc. So that is their real customer. We are the consumers, they are the customers. So what are they doing to make those people feel good, or what are they doing to keep those people connected to Fevicol itself? Are there payment terms, etc. in time? Are those vendors, distributors with them for the company for the longest time or not, is the big question that you ask. Because if the vendors are for the longest time, that means the company is paying them well, the company's business terms are more acceptable. And thirdly, most importantly, that no other competitor can come and take that place away from them, because that's the strength that they've generated. That's one side of the business. The second side of the business is the branding and positioning. So you see Fevicol's branding. I mean, it is a product which is never seen after once applied, because if the product is seen after it is applied, that means it's failed. I mean, if you've taken 2 planks of wood and stuck them with Fevicol, that's the last time you're going to see that product, unless the wood breaks and then you see the Fevicol patches there. And that means that the product has not worked, right? So that is, how do you sell a product like that with the advertising that you do, which people can't even see, and you use it only once?
Yeah,
they've done that extremely well. The positioning of Fevicol Ka Jod has ensured one thing, that no matter what, people will associate Fevicol with a strong bond. So that enables them to look at any two things that can be stuck. So Fevicol as a company has been known to come out with a lot of other products, a lot of other brands as well, where any two things can be stuck to each other. They have a bunch of products which are, to tile adhesives, wallpaper adhesives, etc. So marine, Fevicol XYZ. So for different products, that is an important note.
Yep.
The third most important thing that you look at in terms of the product, the third most important thing that you look at is what is the spend that your end customer is doing as a proportion of their overall spend in that product. Now, for Fevicol, for instance, my overall spend on adhesive when I'm going to make furniture is no more than 2 to 3%, at best 5%. So if I'm making 100 rupee worth chair, the cost of Fevicol in that chair will just be 5%, right? So the lower the proportion of your overall cost in the overall spend that you're doing, and if your brand is strong, the higher is the moat. Why? Because competitors can't undercut you with price. So if there is a company that comes in and sells me adhesive at half the price of Fevicol, will I buy it? Chances are I might not, because what do I do by buying it? I save just 2.5 rupees of the 100 rupees that I'm spending, because 5 rupees has been on Fevicol and the other company gives it to me for 15% discount. So that saves me just 2.5 rupees. And what is the risk of me not buying Fevicol? The risk of me not buying Fevicol is my furniture breaking. So will I, as a value conscious consumer, spend that 5 rupees and ensure safety of my overall 100 rupees, or I will save the 2.5 rupees and worry about risk the safety of my overall 100 rupees that I've spent? So to that extent, the Indian consumer and consumers world over are extremely sharp, smart, and they are value conscious consumers. And when I say value conscious, it need not necessarily mean people are looking for the cheaper alternative. They're looking at a price benefit equation. So it is a 2-factor model and not just a 1-factor model. So the price that you are paying for a certain thing versus the benefit that you're getting versus the price that you're paying for something else and the risk that you're getting for not buying anything else is perhaps what the moat of a company is.
That is so well pointed out. Maybe you should make a YouTube video on that. I totally get it when you said about there's no point of giving up Fevicol in comparison to some other new brand, because you're just essentially saving 2.5 rupees compared to 5. I mean, it doesn't make sense because it affects the end product, and then your consumer spending, you don't know if they're going to come back if the product is bad because of the new Fevicol. The next pointer is, let's look at cash flow. How important is in a company, they have amazing product, they have amazing marketing, how good it is for a company, because investors want to make money out of it, right? A great product does not necessarily mean that the investor will make money. So cash flow is something that they do not, the concept is not understood. Do you use any models like DCF or something to understand that?
One has in their profession, like people like me do use some DCF etc. to find out what the operating cash flow of the company is and all. But to the point that you made, Akash, about investors wanting to make money and that's why cash flow is important, I would elaborate that point. And it's not just about investors. Companies should be wanting to make money, and that's why cash flow is important. What exactly at the day is the nature of business, of any business? You can be in a new age business, you could be in an old age business, you could be doing whatever the hell you are doing. The idea is to buy a certain product or a service and sell a certain product and a service by doing a bit of a value add. So the idea is to sell whatever you are selling, be it a product or a service, at a price which is higher than the cost that it is that you are incurring to go ahead and sell it. And if you do that consistently, you will always have better operating cash flow. Because if you are investing in something which is a long-term thing, then obviously it is going to be depreciated over a period of years, etc. That and CFI, which is cash flow from financing and cash flow from investing. If you are borrowing some money, if you're repaying some debt, if you're buying some assets for the long term, which need to be depreciated, if you're buying some technology for the long term that needs to be spread over the years. So you have to look at cash flow from operations. That, according to me, is the most important thing that any company can report. And secondly, in cash flow from operations as well, you have to look at the kind of other expenses that the company is making, which are actually long-term and are being expensed in the 1 year itself, or looking at in expenditure that the company is doing, which is actually for that same year, but they are spreading it over the long term to to overstate their cash flow from operations. So you have to look at cash flow from operations, the nature of the expenses that the company is doing, which it's either taking on the balance sheet or the income statement. If they're taking an expense of a long term the income statement, then negative operating cash flow is not necessarily bad, because ideally the expenditure that they've made will last them for the entire year, and will last them for a period beyond that entire year, and better performances going ahead as well. But if it is an expense that will benefit or affect the company only in 1 year, and they are spreading it over multiple years to overstate their cash flow from operations, then that is a red flag, because that is something that the company is doing to window dress their accounts. So to that extent, cash flow is extremely important. You also have to see, the cash flow from in CFI. You look at what the company is doing with regards to the financing of the investment that they are making. How much of that is coming from CFO and how much of that is coming from CFF, which is cash flow from financing. In financing, how much is the company getting from equity? How much of that they're getting from debt? Typically, companies which are often, highly leveraged, keep taking more debt, and which may not necessarily be the good thing. But when companies raise equity, little do we realize that cost of equity is much higher than the cost of debt. So those are a couple of things that we have to monitor as well. And nature of companies, for companies which are highly capital intensive, the most important factor to also watch out for is for asset turnover, the kind of returns that they should be on the capital investments that they're making. And that is also telling of the nature of the management, the integrity of the management as well, because oftentimes you may realize that this is a company which has a fair amount of gross fixed assets on its books, and it continues to do a lot of capex with the asset turnover ratio not matching the peers or not matching the management's own commentary itself in the past. So if that happens, then there is reason to worry that are these guys siphoning off some money or not? So those are a couple of factors you need to watch out for.
That makes sense. I have question about portfolio construction and diversification, because I think that is very important. You can't just put all your eggs in one basket, because as Warren Buffett said. Yeah. What do you have to say about that? What should be the allocation percentage wise?
The allocation percentage wise would be pretty simple. Just divide a portfolio into 3 parts. One part should be extremely risk free. So that would be, this is just broad, and this should work for individuals basis their risk reward, etc. So one part should be, entirely risk free, which would be your short-term liquidity instruments, or FDs, government bonds, etc., and should consist of gold as well. And these are only financial assets that I'm talking about. I'm not talking about real estate and all of that. The second part should be 33%. The second 33% should be largely index facing, so that you don't miss out on any beta opportunities. So your portfolio construct should be similar as the frontline index. And the remainder third is where you do all your masti, where part of it you allocate purely towards trading, and that is the money that you want to take a punt on, etc., and all of that. And that's what you play from the remaining third. A part of that third you can put in mid caps, high conviction small caps, good quality companies where you do believe that this could be an extremely big opportunity in your overall investment journey, etc. So you take your punts in the bottom third of your portfolio, and if you stick by this, then at least 66% of your portfolio can withstand the stress that the other 33% can bring you.
That makes so much sense. I'm going to wrap up this podcast with last 2 questions. So there's going to be quick ones. You work at CNBC, you prepare all these research reports, stock specific, sector specific. You tell your audience by coming on CNBC channel. And I see people throwing a lot of these questions on Twitter as well. Do you feel an incredible amount of pressure because somebody out there is making their financial decisions based on your research report, which could go wrong? So do you have to triple check it and be thoughtful of what you say? Do you feel that pressure when you're out there saying your thesis out to the world?
I don't feel pressure, but I feel immense responsibility, and I'm extremely mindful of all the things that you're saying, that people are listening to me by virtue of being in a position which allows that kind of public exposure. People can be making their financial decisions, they're putting their hard-earned money, and most importantly, they're giving me the most important and the most essential resource in the world right now, and that resource is that of attention. They're actually listening to what I have to say, when they could easily be watching 100 videos on Instagram, or they could be watching 100 different channels, or they could easily be doing 100 different things. So the fact that they've taken out their time to listen to what I've been saying is an extremely honorable position to be in, and I am extremely mindful of that responsibility. And till the time I'm here, I will ensure that I will never squander upon that. I will only work towards the betterment of what the viewer wants.
I love that trait that you have. I usually don't feel jealous about people, but there's one thing that I feel jealous about, and I'm going to tell it to you. You are one of the few people in India who got to interview Bono and The Edge when they were in India. So I'm a big fan of you too. So tell us, how is Bono like in person? How is it like?
He is amazing. It was amazing. And as I speak, I get goosebumps, because let me tell you a couple of stories about not just Bono. So anyone who knows me would know that I'm a massive Steve Jobs fan, to the extent that someone can call me a Steve Jobs devotee. And Steve Jobs and Bono were very, very close friends. So much so that, in my Bono interview as well, I did speak to him about Steve Jobs, and Bono spoke about Steve Jobs so fondly. And he spoke about things that, we wouldn't have heard of before about Steve Jobs. So that was a great experience. The second part was that where we were doing that interview was in Electric Lady Studios in New York, which was a studio founded by Jimi Hendrix about 50 years ago. So imagine sitting in New York speaking to Bono in a place which was founded by Jimi Hendrix. It's surreal. happy for that experience. And Bono, of course, I mean, who's not a U2 fan? Anyone who's heard any sort of music in their life, any sort of international music in their life, has to be a big fan of U2. So I'm just thankful that I got the opportunity. Bono was amazing, and this is something that I've never told out in public. Before the interview, usually it's the managers of the band or the managers of the person you're interviewing come by, and the managers are extremely uptight more often than not. What I've noticed is that the subject of the interview is usually extremely calm. It's the managers who say that, okay, this is what the subject won't do, this is what these guys won't do, and all of that and stuff. They try to set it up, they try to hype their clients up, etc. But the manager came to us and they said that at U2 we have a policy, and I was hoping that they will have a policy of something, etc. These are the questions that need not be asked, etc. Because that is what usually happens in a lot of places. So I asked, what is the policy? He said, we have a policy of not answering any question. So you can go ahead, ask whatever the hell you want to. And I'm like, wow, that is pretty good. And that was something that that is something that I learned from that. And I have a policy of not answering any question, and I have a policy of not asking any question either.
Come on, it's too kind of you. Any last few words? We have 2 minutes. Any last few words that you want to share with your audience, and then ask you for a quick post for thumbnail?
The last few words that I have is just be extremely calm, keep it simple. Don't worry about what the other people are doing. You have your plan and you go as per your plan, and do things not for results, but the joy of doing those things themselves. Focus on the process. Results will keep coming. It sounds very preachy, etc. and all, but I can say this with experience. If you just keep your head down, you keep working, keep approaching whatever you work on with utmost humility, you will never be pressured about anything, and keep your process pretty simple. And the one thing that I wish I would have known much earlier in my life, and which I can ask you guys to learn right now, is that try to learn the difference between a good decision and a good result. A good decision may not always be a good result, but that does not mean that you don't try to take good decisions. You can invest in a stock because someone told you and you made money. That's a great result. But is that a great result? No. Whereas you do your research, you have your thesis intact, and you don't have enough money, or you don't make enough money on that stock. That's not a good result, but that's a great decision. So try differentiating between decision making and the result, and you'll be happy in your life.
Awesome. That was great advice. Thank you so much, Mangalam, for coming on. We have last 30 seconds. I hope you found some value. It helps you being a successful investor, and then you can email Mangalam in 10 years, thanking him. Until next time, thank you so much, sir.
You too.